Hello, everyone. Welcome to today's webinar. I'm John Williams from Bautis Financial. And to get started today, I wanted to start with a little quiz, a little knowledge quiz. So I'm just going to jump right in here for the sake of time. Take a second now to read these three statements, A, B, and C, and then match it to its correct answer. Match the correct answer to the correct statement. Your answer choices are 3%, 8%, and 70%. Let me read the statements while you consider your answer. So A is the percent of Americans over 65 who will need long-term care sometime in their life or sometime after 65. And just pick your percentage, 3, 8, or 70 there. And B, percent of Americans who think it's very likely they will need long-term care at some point in their lives. So the percentage of Americans who think they're going to need long-term care. So pick one of those percentages. And then C, percent of Americans who have long-term care insurance. So those Americans who actually have long-term care insurance. All right, so let's see how you did. Let's go through some of those answers there. The percent of Americans over 65 who will actually need long-term care insurance. And the answer is 70%. So the high one was the actual people who will need long-term care. Percent of Americans who think that it's very likely they will need long-term care at some point in their lives. And that answer is 8%. And then finally, the percent of Americans who have long-term care insurance, and the answer is 3%. And we'll get to the gap here and how this all plays into our conversation today. You can imagine how, but you can see there's quite a knowledge gap as to what is reality and what people think. So thanks for playing along with that little quiz there. I think it's a good warm up for us to kind of get into the mode of how important this subject really is. So welcome to our presentation, Getting Long-Term Care Planning Right, Smart Approaches for People at All Stages of Planning. My name, like I said, is John Williams, and I'm an advisor at Bautis Financial. I want to thank you for attending today and learning more about this topic. And I want to assure you of one thing. After this presentation, I believe you'll be much better informed about the various ways people can plan and look at long-term care planning. Now, you may be wondering, why am I giving this presentation about long-term care planning? Well, from time to time, I do deliver other presentations on various financial education topics, such as Social Security, retirement planning, tax planning, IRA planning, among others. My goal is always to inform and educate my audience so you can understand how critical financial planning topics affect you and your family. And I find this to be very, very important. And this is one of those important topics that goes along with that. I do this presentation because I've had many client families who confront the challenge of long-term care. Some have done a much better job of planning for it than others. And my goal is, as you'll see, is to encourage you and your family to make plans now and not wait. We all want financial security, of course, in retirement. When we can address how we'll pay for long-term care, we are always looking for that security and a way to enjoy our retirement and have an optimistic future about how our retirement is going to go. And this presentation is organized into 4 keys. Each one builds on the previous one. And now you might have some questions as we go along. I'm always trying to respect people's time, so I won't be taking any questions during the presentation, but I will leave a little bit of time on the end for any question and answer. I also want to mention, at the end of the presentation, I'll invite you to a long-term care planning overview meeting. So if you have some concerns after this presentation, I will offer that to you. This is, of course, of no charge, one-on-one meeting, just to discuss any of your concerns, anything that we discuss here today, and you just tell a little bit more about some of the things you might do based on your unique situation. I also want to assure you this is not a sales presentation. You'll hear nothing remotely close to a sales pitch, just to get that out of the way. So let's proceed. Let's start by asking, why is planning for long-term care important, and what problem does it solve? Well, the problem is when it comes to planning for a safe and secure retirement, long-term care remains a confusing and unaddressed challenge to many people's financial security. And why many people understand the basic idea that some retirees may need long-term care planning for it is very often overlooked. And there are many reasons why people put off planning for long-term care. They include, and sometimes, they think people feel it's like way too remote off into the future. Many people think, and we have We have some toddlers in the house, so if you hear some rattling in the background, that's that's the joys of working from home. That's one of my 4 sons going down for a nap. Many people, one of the other things, some of the other things are many people think they already have a good financial plan, but it may not address long-term care, long-term care directly. It's a stressful, just a straight up a stressful subject for a lot of people, and they just straight up just don't want to think about it. A belief that Medicare and Medicaid will pay for it is something else that's just many people think that when they get to the end of the road and they have that backdrop of Medicare and Medicaid. We'll get to that in a little bit. A misconception that people won't need to pay for care, or that their families will take care of them. A belief that it's too expensive and out of their reach. And really back to that planning part of it is some people, they feel like they have a good, strong plan and they expect to just pay for it out of pocket. And finally, a belief that all long-term care won't be needed. The costs and risks associated with not planning for long-term care extend to your family, as well as include emotional and financial issues. On the emotional side, lack of planning may result in family strife about responsibilities and care arrangements. It's not uncommon for some family members to shoulder the vast amount of the responsibility for overseeing, even giving care to a loved one. When not planned in advance, trouble often ensues. Making some of these late decisions for loved ones, where cost and quality of care comes into play, can be extremely stressful on you and your family, and can lead to some of these issues. Many of us are familiar with the phrases sandwich generation, and taking care of an elderly family member is one daunting half of that equation, where that term comes from. And on the financial side, lack of long-term care planning can also have great cost implications, including loss of wages if you're not able to pay for the care and rely on them as much and rely on them to provide much of it to you, as far as the planning is concerned. A haphazard, unplanned approach to paying for long-term care can result in very different and unintended tax treatments for money you wanted to leave to your heirs. And of course, your retirement estate plans and wishes, like helping to pay for grandchildren's education, may not come to pass if you're forced to use up all your savings to pay for long-term care. And when a plan could protect those goals, it's nice to be able to look at those things and protect some of those things that are important to you. To sum it up, just imagine for a second the picture of an 85-year-old woman. When we're thinking about long-term care, this is what we sometimes think about. The picture of that 85-year-old woman trying to care for an 87-year-old husband. It's not a pretty picture. And on that, now I can imagine some of you saying to yourself, whatever happens, I just don't want to be in a nursing home if at all possible. And that's a pretty common feeling. And that brings us to our first key. Long-term care isn't about an elderly person sitting alone in a nursing home. It's a range of different services designed to help people with health and personal care needs. So it's a much broader idea than what we might think, that our thoughts are kind of leading us to. So we haven't yet defined exactly what we mean by long-term care. So let's get a little bit into that. Now, the National Institute of Aging defines long-term care as a variety of services designed to meet a person's health and/or personal care needs, so they can live as independently and safely as possible when they can no longer perform everyday activities on their own. These everyday activities are often referred to as the 6 basic activities of daily living, or sometimes referred to as the 6 ADLs. And that includes bathing, dressing, eating, transferring, which would be to walk or move oneself about from a wheelchair and back again, depending on if there is a disability, toileting, and incontinence. So those 6 things are going to be taken into consideration when we're looking at long-term care and whether the person is eligible for long-term care or in need of long-term care. Additionally, the care could be fully hands-on care, where the care recipient is completely dependent on the caregiver to perform all these activities, or as simple as standby care to provide some assistance as needed. So there's a lot that can go into it. It could be this really broad definition, and it could be a much more narrow definition, or part of the definition of long-term care. So who will really need long-term care? There's a widely held belief that long-term care planning isn't necessary because it's too far off and likely won't be needed. Now remember our question from the long-term care quiz, question A, we asked the percentage of Americans over 65 who will need long-term care. And then there's the question B asks a percentage of Americans who think it is very likely they will need long-term care at some point in their lives. And you see only 8% think they'll need long-term care, but that's widely off the mark. While it's true that as recently as 2016, just under half of all Americans over 65 would have no long-term care needs in their lifetime. As of 2021, someone turning 65 has almost a 70% chance of needing some kind of long-term care service or support in their remaining years. And of those 70%, 10 to 15% will need care for more than 3 years. Additionally, the number of people with Alzheimer's dementia is rapidly increasing. Between 2017 and 2030, the total number of people living with Alzheimer's is projected to increase by 35%. And the projected number of new Alzheimer's cases is expected to increase by 110% between 2010 and 2015. So it's no secret that we start hearing more and more cases of Alzheimer's, and it's on the rise, unfortunately. Long-term care is provided in many different settings as well, including at-home care, community-based care, and a wide range of other live-in options, from independent living to assisted living with add-on care to full-time nursing care. Often, as is the case with Alzheimer's and other degenerative diseases, full-time skilled nursing care may follow a much longer period of long-term care provided in other settings. So let's take a deeper look at these other options. While being cared for at home in one's declining years is one of the most common ways long-term care is provided, relying just on extended family and friends is no longer the only option. As we know, relying on loved ones for your long-term care needs is fraught with both financial and emotional challenges, as we talked about earlier. So fortunately, one can receive many services at home that in the past were provided just by family. And these services can accommodate various levels of need. And those include part-time or full-time home health aides who attend to daily living needs and household chores. Also, visiting nurses and doctors who can provide medical care. Other support services like Meals on Wheels, which can provide food and other services. Necessary medical equipment that can be used at home, and case managers to help monitor the needs of the person receiving the home-based care. While care in one's home is sometimes also called community-based care, there are programs outside of one's home that can supplement the care one is receiving in their home. Now, depending on the state, these adult care centers may be licensed or not, depending on what services they provide. So some may provide just social activities and interaction with others, while others will provide healthcare services. So there's a difference depending on the state that you're in. In addition, they can provide needed respite care to the in-home caregiver. So, and what that is basically going to be whether a loved one is taking care of that person, you hire a professional to really give them a break and help them out. As the name indicates, those living in independent living settings are primarily able to live on their own. While this term can cover those still living at home independently, it often refers to housing units, often apartments or townhomes, that are connected to a continuing care retirement community, which we'll later we'll refer to as CCRC, which is a continuing care retirement community. It's basically like this continuation of care as the person needs more of it. In a continuing care retirement community, there are options to step up to a more robust form of care, so like assisted living, which we'll discuss in a little bit. But often seniors are able to stay within their independent living home in a CCRC or retirement community longer than they may have stayed in their own home by adding limited support, like help with taking medications or some other personal care. So in retirement communities, this additional support is often called independent living plus. So you're living on your own, but you're getting some help. In a CCRC, if a resident needs progress or become more extensive, so if those needs become more expensive, then they move to an assisted living part of the community when that becomes necessary. Now, assisted living is an example of something in the middle where the resident may need help with daily medications, dressing, grooming, but can still perform some of these activities on their own. If one needs help for some of these activities of daily living, or if one needs help with the activities of daily living, and it exceeds what's possible for them with added services, as one continues to live independently, stepping up to assisted living, this basic flow, that's basically assisted living is most likely the next step. And in assisted living communities provide personalized care in a residential setting, usually allowing residents to bring furniture from home and they're providing social opportunities to become part of this community. So even though they're needed of more care, it's almost like this retirement home where there's like little sections set off, and they're almost like little living settings. While those in assisted living settings need more care than those in independent living ones, they don't need the full-time skilled nursing care provided in a nursing home. Additionally, assisted living communities often provide their residents with options for meals, laundry, housekeeping, and transportation. So it's a nice little package to kind of keep things moving along for that next step. As one might imagine, the cost for all this care can be quite significant. So medical costs in general keep rising. There's no mystery there, and especially for retirees. So this medical costs are increasing, especially for retirees as their health care needs increase, as you can imagine. So in 2021, the average 65-year-old couple would need about $300,000 in today's dollars for medical expenses in retirement, excluding long-term care costs. So that's $300,000 excluding long-term care costs. And for individuals, the number is $157,000 for women and $143,000 for men. So that's basically up about 30% from 10 years ago. So it's on the move, it's growing and at a rapid pace. Of course, as those median national numbers, of course, those are median national numbers. There are many places where the costs are much higher. For example, in the New York City metropolitan area, the median cost per month for assisted living is $5,991. And for a private room in a skilled nursing facility, it's $12,927. So half of the options in the New York area cost even more than this. Being that those numbers are the median, and they're quite high for being in the middle. And these are today's prices. Like other healthcare costs, the cost of long-term care is going to continue to rise over time, and at a much faster rate than the general rise of cost of living or inflation. Now you may be thinking it's good to know that there are feasible options beyond just a nursing home. They seem expensive though. But won't Medicare or Medicaid, you might be thinking, will Medicare or Medicaid cover this if my needs are really serious? That thought brings us to our second key to understanding why long-term care planning is a critical piece of achieving a safe and secure retirement. Key two, counting on Medicare or Medicaid is not a plan most people want to rely on for long-term care, and many just aren't eligible. In the next few slides, we're going to explore the misconceptions about using Medicare and or Medicaid for paying for the rising cost of long-term care. Now, many people incorrectly believe that Medicare will cover their long-term care costs. As good as Medicare is, long-term care is not covered by Medicare. Medicare only covers short-term rehabilitative care that is less than 90 days. The key word here is rehabilitative. For Medicare to pay for any services, the medical opinion has to be that patient will recover and be able to live a fully independent life again. So they need to it has to be the opinion of the doctors that this is a rehabilitative process and they're going to get back to living the way that they were. And additionally, if you're covered by Medicare for rehabilitative services, it's important to understand that Medicare only pays for certain short-term services like skilled nursing and therapy, such as speech therapy and physical therapy, but does not pay for custodial care, the kinds of help with daily living activities long-term care assists with. It also pays nothing for the cost of senior independent living or assisted living facilities. Now, Medicaid is not Medicare. Medicaid is a state and federal funded tested poverty assistance program, and it may cover long-term care for eligible individuals. Many low-income Americans use Medicaid to pay for long-term care, and Medicaid does, in fact, pay for long-term care services that Medicare does not. But if this is all you know about Medicaid, you can be in for some upsetting surprises, such as the following. A key surprise is finding out that you must use up almost all of your assets first to pay for your care. Before you can qualify for Medicaid benefits, you have to basically, the applicant can only have $2,000, so you have to whittle your assets down to $2,000 in assets. Though your non-Medicaid spouse may be able to keep some of the limited amount of their assets, amounts vary by state. The key takeaway here is you have to spend down to close to $2,000, and you have to basically spend a lot of your assets on care before you qualify. Income is also the income that the recipient of care is also going to be greatly affected, with most states capping income around 100% to 200% of the federal poverty level. So just to give you an idea of what that might look like, in California, a person can make no more than $16,000, just over $16,000 per year, or $1,366 per month. So it's quite limited. And while there are some income and asset protections for a healthy spouse of a Medicaid qualified long-term care recipient, these protections are not unlimited. Even if you have exhausted many of your assets as you approach the need for long-term care and your income is low, what's known as the lookback period may still disqualify you from enrolling in Medicaid. And what this is this usually covers the 5 years prior to your Medicaid application. So putting your Medicaid application in, they're going to look back 5 years prior to that, the submission of that application. And this look back period seeks to establish if you have transferred any assets to anyone else during this 5-year period. And if the assets transferred during the look back period would put you over the Medicaid asset limit, you will be disqualified from Medicaid, even though you no longer have assets at those assets that you transferred at the time of the application. Even if you do qualify for Medicaid, you may still have a rude awakening. Now, there's a significant shortage of Medicaid beds within long-term care living facilities of all types. Not every room or bed in a facility will qualify for Medicaid payments, and long wait lists for Medicaid beds can exist even with overall lower occupancy rates. Sometimes people do not initially qualify for Medicaid when they first enter a long-term care living facility. So you enter into the facility and you have some assets to pay for your care. And as you spend down your assets to pay for the housing and care, you may become qualified as you approach that $2,000 limit. While this may sound like an okay option, there is yet one more surprise. The room you have been living in initially going into that long-term care facility may not be one of the designated rooms, and you might be forced to. It might not be designated by Medicaid or qualify as Medicaid. So you may be forced to move from the room you've been occupying to that point to a less desirable Medicaid room when Medicaid starts paying for the care. The shortage and wait lists for rooms and the issue of being forced to move to a different room will become even more significant and common as the baby boomers age. It's said that by 2030, all boomers will be 65 years or older. So in year 2030, those in that generation will be over 65, making 1 out of every 5 US residents of retirement age. And since Medicare doesn't pay for long-term care and Medicaid requires you to use up your assets, without any other plan, these very big costs will have to come out of your own pocket. Even if your retirement planning took future non-long-term care medical expenses into consideration, which as we know can be quite significant, you can see how long-term care expenses can eat into your planned annual income numbers that you had planned in your original plan in a big way. So all of this is just another way of saying that not planning for long-term care it can be a costly and risky mistake. So at this point, you probably get that it might be prudent to sit back and do some planning and not rely on Medicare and Medicaid. But you may be thinking, well, I've heard over the years that long-term care insurance it's not a good deal. So there really aren't any great options. So that brings us to our third key. Given historic problems with long-term care insurance, it's understandable that people have avoided making a plan. And basically there's just been a lot in the news about the long-term care planning, especially insurance, which we're going to touch on here in more depth. But while long-term care insurance is only one way to plan for long-term care, it's understandable that people would avoid this topic altogether due to these historic problems with products designed to address this concern. It's quite possible that you may have had a loved one purchase what we call first generation long-term care insurance. And you may, through them, have had a bad experience with these original policies, traditional long-term care insurance policies. This insurance was first introduced in the late 70s. So it didn't really catch on until the late 80s and early 90s. And at the time this original long-term care insurance was introduced, there were really two options for receiving care: nursing homes or at-home care provided by loved ones. Concepts like adult daycare, and assisted living were foreign to most people at that time. Now, during the 80s, the options for care started to expand, as did the demand for these original long-term care insurance policies. It provided a good option to one of the more common ways people paid for these costs at the time, simply by selling their home. Many insurers got many of these insurance companies saw this as a great opportunity and got into the business because it could seem like a good option. And while these original long-term care insurance policies seemed like a good idea, and they were a hot commodity in the 80s and 90s, eventually they became fraught with problems. One of the problems was that in the original underwriting, the insurers greatly underestimated both the increases in longevity and the increases of healthcare. Unlike life insurance or medical insurance or car insurance, which you might buy multiple times over the course of your life, by design, long-term care insurance is something you buy once and likely hold on for a long time until you need the benefits. And as these policyholders that had these policies started making claims, many years or even decades after buying the policies and having paid premiums all those years, insurance companies began to figure out their mistake of underestimating the costs. What was once seen as a lucrative option was now understood to be really by these companies a money-losing product. Some insurance companies made good on these claims and lost money, some did not. The policyholders ran into all kinds of issues when the insurance companies tried to fix their mistakes. And some of these issues may include skyrocketing premiums, including what they call post-claims underwriting. And that's basically charging a new premium based on the claims submitted. Refusals to qualify policyholders for benefits if they did not require nursing care in addition to custodial care, and requiring hospitalizations prior to covering. So they weren't given care unless they were actually hospitalized first. And policy cancellations just really for no reason at all, other than the non-payment of the premium. So there are some companies who are just canceling the policies altogether. But the good news is long-term care insurance has improved over the past 25 years greatly. Regulators enacted major reforms in 1993, 96, 2000, and 2005 to provide some consumer protections after this long period of the product being really just falling short. These include requirements that all new long-term care insurance policies will provide coverage for all forms of dementia, including Alzheimer's. So those have to be included. Cannot require hospitalization in order to qualify for benefits, which is a big one. Cannot require that skilled care be needed in order to pay for custodial care. Made language under which claims can be made clearer. They do all underwriting up front. So there's none of those post-claim, no post-claims underwriting. So no jacking up the premiums after a claim is submitted. They cannot be canceled by the insurer for any reason, except if the premium is not paid, and the premium increases are heavily regulated. While these regulatory changes made newer long-term care insurance policies more appealing to consumers, the changes were not retroactive. This means that older policies without these protections are still out there and they're still causing problems, unfortunately. So you may be starting to get the idea. Planning for long-term care almost seems failing to plan for long-term care almost seems futile. But there's actually good news because of those historic challenges around those historic challenges we just discussed around long-term care. There have been a lot of changes in recent years, and there's reason to feel hopeful about the long-term care taking on this long-term care challenge. So that brings us to our fourth key. And that's new approaches to planning for long-term care address people's skepticism and provide a wide range of flexible options for people at all stages of financial planning and health. These newer approaches to planning for long-term care are as varied as the people who need them, providing a wide range of flexibility and security to the people at all stages of the financial planning and health. They roughly fall into a few categories: improved long-term care insurance, long-term care options on life insurance and annuities. So there's now there's long-term care options built into these life insurance policies and annuities, and other financial instruments and assets, which we'll touch on each. As discussed earlier, regulatory changes led to improvements in traditional long-term care insurance. So the traditional long-term care insurance means that you pay a premium for a future claim for long-term care needs. There are no benefits outside of the long-term care coverage, though the details of the benefits vary from policy to policy. They frequently have cost of living protections, which is nice because obviously the inflation and there's cost of living increases. So there's cost of living protections, so the benefit will increase over the years, protecting you against this rise of cost of healthcare and inflation. The next category of approaches for planning for long-term care is products with long-term care benefits. The most well-known of these are life insurance policies that have these, like I was mentioning earlier, a long-term care benefit option, but they also include annuities that carry similar long-term care features. These policies are sometimes referred to as hybrids, as they provide the benefits of life insurance or the annuity and the benefit for long-term care built within them with that option. So they're very popular as they provide a benefit even with no long-term care is needed, where the traditional policy will only pay or have a benefit if you need the care. These policies can give some peace of mind that long-term care needs will be met, while also providing a death benefit if the long-term care benefits are not used, or if the benefits do not exceed the death benefit of the policy. There are other financial strategies that can be leveraged for paying for long-term care costs. So let's look at just some of those other options. One option is for those who own their homes to take a reverse mortgage. These allow homeowners basically to draw against the equity in their house to pay for long-term care costs. One downside of a reverse mortgage is that you're potentially using up the equity in your home, but they usually include various benefits, and those benefits include tax benefits, as loan proceeds are generally not taxed. When the home is sold to repay the mortgage, if the proceeds of the sale are less than the mortgage company has to take the loss rather than being able to go after other assets of the homeowner or the homeowner's estate. And it usually means that the homeowner cannot pass on the home to his or her home to their heirs. So basically, one of the downfalls is you are basically looking at this home and pulling the equity out. And if you had plans for passing the home on to your heirs, this might not be a possibility. Another way to use the equity in your home, though, is to pay for long-term care is by setting up a HELOC, or a home equity line of credit. It allows the homeowner to draw against the line of credit when funds are needed. Often there is no or a very minimal annual fee to maintain the line, and no interest paid if no draws are made. HELOCs have many different structures, so they can be structured in many different ways, with interest only or principal and interest payments options during the draw period, and various draw repayment terms. So they're going to be structured in a lot of different ways. And a lot of times there's a way that you can structure it that meets your needs. Cashing in an existing life insurance policy for living benefits is another option that we look at. So for those over 65, selling a life insurance policy to a settlement company for a percentage of the death benefit is one option for funding long-term care. The percentage received is dependent on one's age and health. So these settlement companies will look at all the variables involved, including the age and the health status, and determine a percentage of the death benefit that person would receive to pay for some of this care. And many life insurance policies also offer these what they call accelerated benefits to pay for care for those who are terminally ill. So if the person's terminally ill, they will extend some of that death benefit to the person to pay for some care. Another option is to use pre-tax savings like an IRA to purchase long-term care protection. Retirement assets can be surprisingly substantial and a good source for long-term care needs. So like using a Roth IRA conversion, for instance, of a portion of a traditional IRA, or a backdoor Roth IRA contribution for those who make too much to receive the tax benefit of just a straight Roth contribution, can help create funds to pay for long-term care, as Roth IRAs can grow tax-free and are not subject to minimum distributions. Long-term and disciplined funding and use of also a health savings account is another way to help pay for long-term care, as both the costs themselves and long-term care insurance premiums can be qualified as health expenses. So the money that you save throughout your planning process in these health savings accounts actually can be used to pay for these insurance premiums. There are challenges and drawbacks to each of these strategies. So further discussion, of course, around this strategy and paying for using them to pay for long-term care is needed, but it is one of the things we would look at. And what about simply self-funding one's long-term needs when and if they arise out of their own investment assets? Should you self-fund? Are you relatively young and healthy? While self-funding is always an option, one school of thought suggests that investments are not a substitute for insurance, and insurance is not a substitute for investments. While it makes sense for some people to go in this direction, for others it does not. Here's an example where it might not. Additional challenges of self-funding include not knowing. You're just not going to know when you will need the care and for how long. So it's really hard to plan around something that has something you just don't know. The school of thought that says investments should be investments, insurance should be insurance, also says that you really want to look at it from two different angles. Invest well to ensure financial independence, insure well to protect financial independence. And just pointing out the differences between like how investments are going to be approached and how insurance is going to be approached. As mentioned earlier, these long-term care options are as varied as the people who need them. So which factors go into determining which is the right one? There are going to be many different factors, but some of them include your age, your marital status, your health, and if married, the health of your spouse, military service, because there are some veterans that might be eligible for long-term care assistance. Where you live and where you intend to retire is going to have a great effect on the cost. Your family health history is going to dictate really how long you might live. Your assets and wealth outlook, your other financial and retirement planning, and your legacy and estate plans, and your needs and wants there. And while some may feel too young to be thinking about long-term care planning, some options are really best started when you're young and healthy, because it's going to be the best approach from a cost perspective. Others may think that they're too old or too ill to make up for a lack of planning. But in fact, there are options for people in this situation, as well as all situations in between. So don't make any assumptions and just look into what might be available to you. Overall, and as a good guide, here are some questions you want to keep in mind as you consider your long-term care plan. Who will provide the care? 2, where do you want the care? And 3, how will you pay for the care at the highest level? And it's also important to keep a few other things in mind. Your situation, of course, is unique, and there's no cookie cutter solution for everyone. So advice from somebody else might not be great advice in this situation. and or referring to somebody else who might have a plan in place that might not fit your needs. You can receive care in your own home, whether you pay for it with a policy or with other strategies, so something to consider there. Having a plan is important. It doesn't mean that a plan has to necessarily cover all the costs. So, having a plan and having something in place is better than nothing at all, even if your plan doesn't necessarily cover the entire expected cost. Now we're getting close to finishing up, so let's recap. We started with this problem. When it comes to a safe and secure retirement, planning for long-term care remains a confusing and unaddressed challenge to many people's financial security. Then we discussed the 4 keys to gaining financial security through planning for long-term care. Key 1 was long-term care isn't about an elderly person sitting alone in a nursing home. It's a range of services designed to help people with health and personal care needs. Key 2 is counting on Medicare or Medicaid is not a plan most people want to rely on for long-term care, and many are not eligible anyway. Key 3, given historic problems with long-term care insurance, it's completely understandable that people have avoided making a plan. And finally, key 4, new approaches to planning for long-term care address people's skepticism based off of some of these stories and some of the news, and provide a wide range of flexible options for people at all stages of financial planning and health. So that brings us to a natural conclusion, the solution to our original challenge, and here it is. In order to feel safe and secure about your retirement, you need a custom approach, a real plan for how you will pay for long-term care. We've seen a variety of approaches here today to this challenge, and I'd like to invite you to come in for a one-on-one meeting where we can discuss what the options are that you'd like to consider as you plan for long-term care. Developing a custom strategy. Developing this custom strategy that's unique to you to how you will pay for long-term care is a smart and responsible approach to planning for financial security and retirement, and a great way for you to kind of feel some of this security and make sure that your plan is going to see through to as you want to see it, and basically plan your retirement, spend your retirement in the way that you would want to. How can you get a real plan, one that is customized to your unique needs? Well, as I mentioned during my introduction, I always invite people to schedule a no-charge long-term care planning overview meeting. One thing we'll do in our meeting is review long-term care planning options guide that we'll have available, and look at all your different options and make sure we're looking at your unique situation. So you can reach out to me to do this. You can reach out to me directly at john@bautisfinancial.com. That's bautisfinancial.com. Or you can go directly to our website at bautisfinancial.com/call, and there you'll be able to schedule one of those no charge talks, so we can just discuss some of your concerns, any questions that you might have. And that finally brings us to any questions you might have. Is there anybody? Let's see here. I always love, I always wonder if the reason why there's no questions is because nobody liked what I had to say, or if I was just so thorough that they don't have any questions. But of course, if you have any questions, just reach out to me, even if you just want to send me an email with a single question, or if you, like I said, if you want to have a one-on-one, we'd be happy to do that as well. I really want to thank you for joining me here today and going through this topic. Hopefully you learned a lot. You can visit our Learning Center on our website. That is chock full of information on this topic, as well as other financial topics in retirement or your years leading up to retirement. You can find that website at bautisfinancial.com/learning center, where you'll find other webinars, a recording of other webinars we've done in the past, as well as blog posts and a lot more information. Of course, we have to end with your disclosure. The lawyers make sure we throw this in here, but and if you have any questions, there's a lot in here. So I think the takeaway here is to make sure that you talk to someone before making any sort of decisions. But of course, we're here to help you through that. Again, thank you for joining me today, and I hope to hear from all of you soon.